Can you hear me, Roby? I think I can hear. Oh, can
you hear me now?
Yes, I can.
Okay.
Can you hear me?
Hi, Natalie. How you doing?
Good. How are you?
Good, good. Getting ready to roll here. How's baby?
She's good.
Roby, do you mind if I do my act for like 30 seconds here?
Go ahead.
Can I say hi? Millie, right?
Yes.
Can I say hello real quick?
Come say hi. Come say hi. Come on. Let's go.
You don't have to beat her up. Hi, Millie. You got the old pacifier going. You look happy though. You ready, Millie? Da 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 da. Okay, Millie, I'm afraid you have to hit the bricks now, okay? Okay, bye-bye. All right. How is everybody? Everybody's bueno, I hope. Okay. Let's see here. Let me start by sharing a screen here. Can we see the PowerPoints right now?
Yes.
Yep.
Okay. I don't want to make them bigger. What we're going to do today, I think, is go through 2 chapters. Chapter 5 is a pretty short set of lessons, if you will. If I remember correctly, in chapter 4 is where we really start building some statements here, journal entries. Hi, Riley, can you hear me?
Yes, I can hear you.
All right, Riley, here we go. We're just starting with the PowerPoints, huh? Chapter 4. Give me 1 second here. Just a moment. This thing is giving me a little bit of... Can we all see that now?
Yeah,
see college accounting.
It's chapter 4, journalizing and posting transactions. You see that, Roby?
Yeah, that's what it says.
Okay, so I guess we're good. Here we go. The flow of data from source documents. Oh boy. Source document is any piece of paper or conversation you might have had or communication. Source document can be an invoice, an email, a text. It's simply a piece of definitive instructions that you need to do something. So during the period, during the month, you're going to be analyzing things, right? You're going to get that pesky electric bill in the mail, and then you're going to enter it into your general ledger via a general journal or a journal entry. And by posting a journal entry, that updated your general ledger, and then we can prepare what's called a trial balance and prepare the statements. So these 4 steps are kind of laid out right here. The purpose of source documents. Almost any document that provides information, it can be a trigger to do something. Your boss leaves you a note and says, you forgot to pay the rent. And that angry note is a source document, and you would use it to prepare to record the transaction. And in the old days, you would print out that journal entry and staple that source document to the journal entry as evidence of why you did it. Companies may still do that, I'm not sure. So source documents, and they're usually filed because they're objective, verifiable. Auditors love source documents. When the auditor comes in and asks a question, and you say, well, that's how I did it, and you don't have a source document, then he looks at you with askance, and more scrutiny will be yours. More documents, cash, check stubs, receipts, sales tickets. You know what source documents are. The chart of accounts, we've talked a little bit about this. This is the listing of all of the accounts in your general ledger. Anything?
Bob,
Go ahead.
all I'm seeing is college accounting, chapters 1 through 27.
Oh, for God's sake. I'm so sorry, you guys. Thank you for interrupting, Roby. Let me see what I can do here. I don't know why this thing is giving me trouble all of a sudden. Do you see the chart of accounts now?
See it, yes.
And please interrupt me if I start talking about something that ain't there. The chart of accounts, that is all of the folders that you choose to classify information. Every company has cash as part of its chart of accounts because you want to know the details of that accounts receivable. And the chart of accounts goes in the order of assets, liabilities, equity, revenues, and expenses. And I would say most companies number them 1 to 5. Assets usually begin with a 1, liabilities 2, equity 3, 4 for revenues, 5 for expenses. And that's kind of what they're showing you here, okay? So your chart of accounts goes in the order of assets, liabilities, owner's equity, and then below that, revenues, expenses. That's why I say you draw a line here, a horizontal line on the drawing. Everything under that is your income statement, and everything above it is the balance sheet. Journalizing, huh? Journal entries. Day-by-day listing of transactions. That's what a journal is. And when you get going in future accounting courses, you'll learn about cash journals and sales journals. Journal provides a record commonly referred to as the book of original entry. In our class, we're talking about a general journal, meaning we're going to do everything with journal entries as opposed to mass postings. So a journal entry, 2 columns, 1 for debits and credits, and you can put any transaction there that needs to be recorded. That's called journalizing. And each transaction has a date and the account titles and the amounts. And I think this is very important, a brief description. I don't think your homework requires it, but a brief description of a journal entry is quite important. If you can't write a brief journal entry description in about 6 words or so, that indicates a problem, indicates there might be something wrong with your journal entry. Oh, for heaven's sake, come on, what's wrong with this thing? Come on. Okay, I guess they're going to take us right into journal entries now. These are the same transactions, I guess, we saw in chapters 2 and 3 when we were doing plus minuses, and then we learned debits and credits, okay? Mitchell Williams opened up a bank account with $5,000. Roby, what are we going to debit and credit? Can I ask you that?
You just open a bank account for the business. Okay, we would debit cash and credit capital.
Yeah, we know if we know our debits and credits now, we know that cash goes up with a debit and capital goes up with a credit, okay? So let's look at our journal entry. This is our journal entry. It has a date, and it'll usually have a reference number out here, but that's not the case here. But it has a date that it was recorded. It has the cash and the Mitchell Williams capital, which is the pair of chart of account items we're going to impact, okay? Notice the indentation on the credit. You see that, everybody? You indent credits. You indent credits. That's important. If you did not indent it, the journal entry would still be right, but it would look clunky to anybody who knows anything about the world of bookkeeping or accounting. Oops, excuse me. Bookkeeping or accounting. and they're going to question whether you really know what you're doing. So you indent a little bit, okay? And the explanation, owner's original investment in delivery business. Like I said earlier, that can be just a few words. Owner's original investment would be fine. Owner's investment. The explanation is important, like I said, because if you can't write a simple one, it might mean that your journal entry is wrong because you're having trouble describing it. And obviously, it's useful when the auditor comes. This happened on June 1st. The auditor comes at the end of your fiscal year, May 31st. He'll say, what's this journal entry about? Well, depending on the entry, you're not going to remember. And if you don't have the explanation there, you have to do a little unnecessary digging. So explanations I love. Sometimes a journal entry has multiple accounts. And when possible, you put the debits before the credits. That is not a hard and fast rule. And it's impossible in some of the bigger journal entries. But it's a good rule just to get us going here, okay? So I'm hoping you can read this here. Can you all read this here? Supplies, cash? Okay, you have very good eyes compared to somebody else here. So they're showing you some examples of journal entries. Debit supplies, credit cash. As soon as you see debit supplies, credit cash, you know the explanation could be purchase supplies for cash. And you don't have to say for cash. Here, the explanation is receive cash on account from, well, when we get cash on account, we're getting the cash. So our cash goes up with the debit, accounts receivable goes down, okay? I'm not going to go over all these entries, but here's a compound entry. Purchased scooter with down payment, the balance, to be paid later. So we bought a piece of equipment worth $1,000. We had to make a $300 down payment, so that's a credit to cash, and a $700 credit to accounts payable, because accounts payable goes up with our credit, so on and so forth. So they're telling you line up the credits by indenting. Debits must equal credits. My goodness, I didn't tell us that yet today, huh? Debits equal credits in a journal entry. And here they're saying line up the debits, then line up the credits. That's fine if you can do it. It's not always possible. When I worked at the clinics, Santa Barbara neighborhood clinics, and we posted the payroll, it was like 150 lines on a journal entry. And it was a mix of debits and credits. Sometimes you just can't please anybody. So now we posted everything to the general ledger. And the month has come to an end. The general ledger. That's your glorified T account now. Remember the T account? The general ledger is really just a double T account, which you'll see in a second. That represents where the auditors are going to begin. They're going to look at your general ledger. It's the chart of accounts in order, and it's the reflection of those T accounts, all right? And it keeps a running balance. The general ledger also is known as the books. Any of you ever heard that expression? He's cooking the books. I want to see the books. I don't believe this company. So look at the T account versus the general ledger. T account is exactly this part of the general ledger. Would you agree? You agree? Yeah, the T account.
Yes.
Okay, thank you very much. I appreciate it. The T account is a mimic of the general ledger. So let's look at our ledger. You are going to have one account, one number for each account you're tracking. So here's the general ledger. Here on June 1st, this person invested $5,000 in his business. So his business now has $5,000 in cash. The balance after that was $5,000. Then he spent on June 3rd, $2,000. His balance is now $3,000. The general ledger is a double T account, if you will. This is the activity. This is the running balance. Can we understand that? The general ledger, First two columns, the entry itself. This is just a copy of this T account. When you posted these entries, when you hit the button that said post right from here, this is what popped into your general ledger right here. Notice that the balances are all debits, which makes sense because cash has a normal debit balance. If this lapsed into a credit balance, you either made a mistake or you're floating checks or something is wrong. So say hello to your good friend, the general ledger. General ledger. When your auditor comes in, he or she is going to go right down to your balance. And she's going to say, how much money you got, Bob? And I tell them $170. They say, prove it to me. I show them the bank statement and the bank reconciliation. That's not going to be good enough. They're then going to contact the bank. They're going to contact, in this case here, they're going to contact some of the suppliers. They're going to contact some of our customers and make sure that I am on the up and the up. Posting. That's the process of hitting that button to move your journal entry into the general ledger. And this is kind of a long-winded thing. We just did this really. We entered the date in the general journal entry for the general ledger. You enter the date, you put your debits and credits, that's the balance. This page I am skipping. So here's a good representation. Here's a real good representation. Before this business began, there was no general ledger. There was no business. So this guy put $5,000 into his business. He debited cash, which goes up with a debit, and credits capital to increase it. And he puts a reference in here. Here he put the chart of account number, but that can be something else. And his explanation, owner's original investment would have been fine. Just writing that journal entry did nothing. It did not affect the general ledger until he posted it. And like I said, posting is the action on your computerized system where you push the button that says post and it updated the general ledger just like this. So if someone wanted to look at the books of the company, this is it. We just have this one little part of the books. Using journal entry 1, he wrote a JE1. That's just anything you want to put there to track. Debited cash, the resulting balance is 5,000. Okay, journal entries. The trial balance, we've done a little bit of trial balance work, right? The trial balance is simply a listing of your chart of accounts in the given order of assets, liabilities, equity, revenues, and expenses. The only thing the trial balance does for us is prove that debits equal credits. I don't think you will have this problem out in the workforce where everything is on some kind of computer type system. And you can run the trial balance anytime you want. Typically it's done at month end when you're closing. And it's prepared after all the transactions have been journalized at month end, huh? So here's a real simple trial balance. We have balance of cash, we got receivables, ooh, wow. We have a lot of equipment. Here are the payables, equity, revenue, expenses. Well, the trial balance adds up to $14,900. If the boss came out and said, how are things going? You say, great, the debits and credits balance, that doesn't mean anything. Does that mean these numbers are correct? Not at all. Every one of these numbers could be wrong. It just means that you put an equal amount of debits and credits. But the trial balance is crucial because it is from the trial balance that we will prepare the financial statements once we are happy that the numbers are correct. How to find and correct errors. I'm not going to get into this too much. I'm just going to say when you make an error in the general ledger, you can't erase it. You really can't cross it out because it's there forever. The only way to correct is to reverse the entry and then right below it, put it in properly. So you show the wrong entry, the correcting entry, and then the correct entry. Even though the trial balances balances, an item could be wrong, huh? Guess what? We need to be very careful in preparing the journal entries. Who knew, huh? Double checking your numbers here. I just want to show one thing here. Something you might find interesting if you don't already know it. Perhaps you do. Perhaps you know this already. Come on, will you? Why is this thing giving me a hard time? I'm just going to take your attention to transposition errors. Roby, have you ever heard of a transposition error being divisible by 9? You've not heard this before, right?
Yeah, I've heard that.
And what have you heard about it?
Oh, nothing much, just, it's a trick you can try, something you can try to figure out the error.
Yep. Yeah, what we're talking about here is if you transpose two numbers, in other words, you flip-flop them. In this case here, you wanted to enter 270. It was 250 rather. The amount you wanted to put in was 250, but you put in 520. Now you're off, it's wrong. The difference between any such error is always divisible by 9. Isn't that amazing? So if you put in 81 and you meant to put in 18, the difference is 63. It's divisible by 9. Why am I talking about this a little bit? You may be saying to yourself, well, who cares? What's that going to do for me? It used to be quite important when you're doing this stuff by pencil. You'd prepare the trial balance and you'd be off by $81. And the first thing we all did was divide it by 9. If it was divisible by 9, we were 90% sure it was a transposition error, which made it a lot easier to go one by one and check, okay? Transposition errors. Fun with numbers, okay? And if none of that works, double check. Double check. Correcting errors. You can't erase. You can't erase. You have to do a new entry. I recommend reversing the wrong entry and entering the right entry. Correcting. Wow, a lot of correct. They must assume you guys are going to make a lot of mistakes. I'm going to keep going here. Come on. Does anybody play craps? It's like betting against the house the way they're talking here. Come on. That's the end of this chapter? That's the end of this chapter. Well, that wasn't too much. That's why I said today we're going to go into chapter 5. Chapter 5. Because your homework is due for chapters 4 and 5 on October 3rd, okay? Any questions on this stuff here? Everybody okay so far?
Okay.
Okay, I see people nodding away.
All good.
All right, good to hear, good to hear. Okay, hold on here. Let me get into, let me get back to chapter 5. Sorry I didn't get this racked up earlier. Chapter 5, chapter 5. Let me get this lined up here. Can we see chapter 5, adjusting entries in the worksheet? Not yet?
It just says college accounting.
Ta-da, does that work?
Yeah, there you go.
Adjusting,
Yep.
okay, adjusting entries and the worksheet. Adjusting journal entries are gonna trick you for a little bit, okay? Adjusting journal entries. Remember, we made a bunch of, we had a bunch of transactions during the year, right? Or during the month. We entered our journal entries, and at the end of the month, we prepared our trial balance, and the trial balance balanced. And guess what? Most of the information on that trial balance was correct, but there will always be what are called adjusting journal entries. They are unavoidable, and they can only be done after the month ends. Most companies where I've ever worked, the month ends on the 31st, and they say, Bob, you and your guys have 4 days to prepare the financial statements. And during those 4 days, you work very hard to adjust the trial balance. You go over every item on it and adjust as necessary. An adjusting entry is strictly internal, not external. Everything we've done so far involved another party, right? We, for example, bought something and recorded it. We sold something to somebody. We paid our employees. We paid the electric bill. Those are external events. Here, we're talking about end of the period adjustments. And there are certain things that we can do at the end of the month and must do. Equipment wearing out, that's called depreciation expense. So we're going to talk about that. Remember those supplies we bought that are an asset? Remember that insurance policy we bought at the end of the month that covered we bought about 6 months ago that covers us for a year? We've used some of these assets during the year. They need to be recorded. Employees work, but they haven't been paid yet, these type of things. So the adjustments are all based on a very important accounting principle. There's like a dozen or so what are called accounting principles. The matching principle may be the most important. The matching principle means we record revenues and expenses in the period where we earned the, let me say that better, in the period where they took place. So if we had $100 worth of revenue, and Natalie, you worked the last week of the month and you earned $100, that $100 needs to be an expense for that month, even though we're not going to pay you for a while. So let's go into this. Revenues are recorded when they're earned. It does not necessarily follow the cash. And we had those slides, if you remember, where we got the money in advance, we got it afterwards, we got it at the same time. Revenues are considered when earned, when a service or when the shipment is made. Expenses, they're recognized when incurred. It means when we experienced them, when we got the benefit of them. During the month, we had electricity in the office, but we're not getting the electric bill in the mail for a while. We're going to have to do an adjusting entries. Expenses are considered incurred when the goods have been received or assets consumed. That's a clunky bit of jargon there. Matching principle again. Revenues and expenses. What are you matching? Revenues and expenses. Don't answer revenues and liabilities or assets and cap. It's revenues and expenses. Okay? That would give us the true net income for the period. We are doing what's called accrual accounting, ACC or UAL. Accrual-based accounting, meaning we record at the time the event happens, okay? To follow all these principles, we must do it. Fiscal year, a 12-month period of time used in an accounting period. It does not have to be the same as a calendar year. And many businesses schedule their fiscal year to end when business is slow. And adjustments are made at the end of each fiscal year or each fiscal month. A lot of companies, their fiscal year is based on the product cycle. For example, General Mills, which is a cereal company, their fiscal year begins, I believe, on May 31st, because that's when you plant, and it ends on April 30th. So they go through the harvest season. Stores like Nordstrom, their fiscal year may end at the end of February, because they like to scoop up those December sales, and January and February are a little less hectic. So here we go. We're going to go through the world of adjusting entries. You practice when you do your homework. I guarantee you'll get a little stuck at first, but it's really not too tough once you get the hang of it, like riding a bicycle. Huh? I remember that happy day when my father pushed me and my bike, and I successfully rode all the way to my first year of college. It was a great day. Okay, silly joke, huh? Adjust for supplies. During the month, we had $80 of supplies, right? We had 80. That's not an expense. We debited this for 80 supplies, and we credited cash. But we took an inventory, and we see there are only $20 at the end of the month. That means we used $60. We don't have 80 anymore. We only have 60. What is our adjusting entry or adjusting journal entry? Our adjusting journal entry is, they're saying what happens if you don't make these entries. And I'll go back over that at another time. But if you don't make these entries, your assets are going to be wrong. It just means things are wrong if you don't make these entries. So we used 60. Look at our adjusting journal entry. Now we debit the expense, because expenses go up with a debit, and we credit the supplies. That's our one of our basic adjusting entries. So let's take a look here. We debited supplies expense for 60. We credited the assets supplies for 60. Look at our T accounts. 80 was on the trial balance, but that was wrong. It was wrong because we had used 60. That gets our balance down to 20. Excuse me, ladies and gentlemen. And then we debit supplies expense. That is a classic adjusting entry. Your prepaids. Your prepaids, using up those prepaids. And they're showing you here. Prepaid insurance, to me, is a better example. They bought an 8-month insurance policy. It says 8-month over here, and here it's 7 months, so we'll have to live with that. During June, Mitch bought paid $700 for a 10-month policy beginning June 1st. Guess what? At the end of June, he got the benefit of that policy worth $70. Would you agree? It's a $700 insurance policy covering 10 months. So he has used 70 of that 200. Our journal entry, we will debit the expense and credit the asset. Your adjusting journal entries are, for the most part, a search for unrecorded expenses. That's what the adjusting journal entries are all about, for the most part. So let's take a look here. Here we go. Prepaid insurance, it was $700. We got through the month and our building didn't burn down, I guess. So we got the benefit of that now expense of $70, leaving a balance in the prepaid account of $630, and we debit insurance expense. And here's the journal entry. Guess what? We're going to do this every month for the next 7 months. We're going to go 70, 70, 70 for 9 months until the balance in this account is 0, and we're going to record $700 worth of expenses over the year. Okay. So prepaids, that's one. And it's one of the easier ones, I think. Now we're going to talk about what's called an accrual entry. And I bet you've all been out in the workforce. I guarantee you've all had jobs, huh? At one time or another, you're probably working now. During the last week of the month, you earned up until the June 27th, you earned $16.50, and you already got that paycheck. The company debited salaries expense, and they credited cash or salary, and they credited cash, debited salaries payable or salaries whatever. Okay. Now on June 27, after June 27, Riley, you worked a few days and earned $300 from the 27th to the 30th, okay? That expense, that $400 belongs in June. But payday may not be for 2 more weeks yet, right? Nobody gets paid immediately in this country. As soon as you accept a job, they'll tell you that we hold back a week. You've heard that expression, we hold back a week, we hold back a pay period. So, Riley, we have to record your expense of $400. You worked, you earned it. We owe you that money on June 30th. You're just nice enough to go along with our company policy, which is we pay you next week. If you quit on the 30th, Riley, we'd owe you the money. If we fired you, we owe you the money. If the business burned down. So we have to record that expense and the liability, because we do owe you $400 at the end of the month. This represents the last 4 days of the month. We are going to debit wages expense and credit an account called, it should say, accrued wages payable, but wages payable is okay. We'll go along with Cengage. So look what we have here. Here is the $1,650, Riley, that you earned during the month, and we paid you. Then you worked the last 4 days of the month, it looks like, and you earned another $400. That is an expense that belongs in this month. It means we owe you this month. So what we've done correctly here is we have put the proper expense into the system and recorded the proper liability, okay? You can come to me if I'm your boss and say, I quit, I want my pay, and I have to give it to you. This is an important thing here. And when you get into Accounting 230, you look at this a lot. Excuse me. Oh, that's good whiskey. Assets are recorded at their actual or historical cost. And that cost remains on the books, remains on the general ledger as long as the business exists. If an asset goes up in market value, you don't write any journal entry. You can't do that. You had a business, you know, maybe your great-grandfather opened up a business in Santa Barbara and he bought a piece of land for $200 an acre, and now that land is worth $10 million. On your financial statements, it's still $200. And this is a principle called conservatism, meaning you do not adjust for any assets that have risen in value. When do you get the income? When you sell it, if you sell it. So we're talking about fixed assets here. Fixed asset, a machine, a scooter, a truck, a long-term asset, something you're going to have for a long time that's going to help you make money, huh? You bought that big machine, and that thing is going to punch out one can of Coke every second, and it's going to last a long time. Under accounting rules, you can recognize an estimated wear and tear if it no longer satisfies the needs of the business. Expenses should be recognized over the life of the asset. I've talked a lot about that one, but this is the easiest of the adjusting entries. This is the one you pray is on the test more than the others. Depreciation expense, depreciation. A method of matching an asset's original cost against the revenues. And there are various methods. When you get into I think later on we might get into other depreciation methods, but we're going to use what's called straight line. Depreciation expense is based on the estimated useful life of the asset and any salvage value. So let's talk about that. Salvage value. the expected market value or selling price of the asset at the end of its useful life, okay? A good example is we bought a company car. We bought a company car and we gave it to one of the salesmen, and that salesman drives that car all over the country. He's been putting mile and mile and mile after mile on it. At the end of 10 years, that car probably will no longer be drivable. It'll have 300,000 miles on it. But we think a junk dealer will come in and give us 500 for it just to hold it off our property. That's what's called the scrap value, also known as residual value. It's just what we estimate in the future we might get for it, okay? And yes, some of these numbers are estimates that we're going to be doing now. Your financial statement does include estimated number. We're going to depreciate the cost of the asset less the salvage value. So let's take a look here. Mitch bought those scooters, and he said, I think they're going to last 5 years. No salvage value means when this thing, after 5 years, the only thing you can do with that thing is throw it away, okay? So we don't have to worry about salvage value. We are going to take $4,800 and divide it by 5. And that'll give us the annual amount. And then we can divide it by 12 to get it by month. And they're just doing it here by 60 months, okay? So 4,800, that's the depreciable cost of the asset over its 60-month life. 4,800 divided by 60 is $80 a month. $80 a month. We now can record what's called depreciation expense as follows. I'm going to go back to those other slides. I skipped them deliberately. So we know the depreciation expense is a debit of $80 to depreciation expense. And the credit is not to the asset. You see that $4,800 there? That is never going to change. What is going to change is the contra account called accumulated depreciation. Accumulated depreciation. We debit 80, we debit the expense for 80, we credit the accumulated depreciation 80. $4,800 minus 80 is 4,720. That's called the net book value of the asset. And at the end of 60 months, this 4,800 will still be here, and this will grow to 4,800, and the item will be fully depreciated. Book value, the original cost of an asset minus the balance of the accumulated depreciation, and that represents what's called the book value. It's the value that we've not depreciated yet. And this is crucial. These numbers have nothing to do with the market value or selling price of the asset. When I worked in Los Angeles for a number of years, we had a part of our operation had a little printing plant, and we had an old-fashioned linotype machine that was fully depreciated back in World War II. And we hardly used it very much, but we had people coming in and offering us hundreds of thousands of dollars for that machine. It was a collector's item, but it was still on our books at the original cost. Accumulated depreciation, from the Spanish word contra, which means contra, right? Opposite. Contra asset. It's an asset account, but it has a credit balance. You will never, never, never credit the original cost of a fixed asset. Never. Not in this class. The original cost minus the accumulated depreciation gives you your net book value. And there's your journal entry. Debit depreciation expense, credit accumulated depreciation. Whoops. and we're using straight line. And here, they're just showing you now the different accounts we've just introduced to you. The ones in red, you've really not seen before. We have the delivery equipment, 185, and their system adds a tenth or a point here, 185.1, to represent the accumulated depreciation on the equipment. We introduced wages payable. Wages payable represents that last week of the month, those last few days of the month where you worked, earned your money, are entitled to it, but you're not going to get paid till next month. And the different expenses, we debited supplies expense, insurance expense, and depreciation expense. Not too tough, I don't think, so far, as long as you diligently do some of these problems. So now that we've written these journal entries, we're ready to post them. Remember post, Mr. Post. That's going to update the general ledger. So look at supplies expense. We had no balance, right? Now we debited supplies expense, and there's your general ledger. 60 and 60. Posting adjusting entries is just like posting anything else, except here you might use the word adjusting. Or over here, maybe you put AJE, which is what we used to do. And here they're just showing you the, wow, I don't know if anybody can read that. Can any of you read any of that? I'm having trouble getting this thing to blow up here. Okay. Well, what they're showing you here, up here, they're showing you the debit to supplies expense, credit to supplies, and there's the journal, there is the general ledger. Supplies, there's the credit, supplies expense, there's the debit. Insurance expense, there is the debit, and there is the credit. On your adjusting journal entries, wherever you have a prepaid, you know you're going to credit prepaid item, prepaid insurance, prepaid supplies, prepaid rent, prepaid taxes. You know you're going to credit that, and the debit will be to whatever the prepaid item was, insurance or whatever. They're repeating the cycle here. So now that we have finished with our trial balance, we're ready to prepare a worksheet. You excuse me for one moment here. Excuse me for one moment, please. I just have to call this guy real quick. It's a bit of it's a mini emergency, I guess. Don't have the number. Okay, I'll continue here. Okay, we've prepared a trial balance. Now we're going to prepare a worksheet. A worksheet. And this worksheet is going to be 10 columns long. It's going to be a big, long worksheet. And what we're going to do with this worksheet is we're going to start with the trial balance. And in the next two columns, we're going to put in our adjusting journal entries. And then the next column, we're going to put in the correct or adjusted trial balance. And then the next two columns could be your income statement and balance sheet. 5 steps. Prepare the trial balance. Prepare the adjustments. Now we have an adjusted trial balance, and you know, you're the boss, Natalie, you're the boss, and you look it over and you say, okay, everybody prepare the financial statements. So now you're ready to do just that using this worksheet. And the header is the name of the company, etc. This worksheet is not a financial statement. No one is ever going to see it except you in the accounting department. But it's the basis of preparing the statements. So you prepare the trial balance, huh? The trial balance. We should know it's the debits and credits. We should know it plays a single rule, double rule. Sorry, I went into that. Step 1, prepare the trial balance. We know how to do that. 2, you write the adjusting journal entries, which we just went over. And then on our worksheet, and this is our worksheet, we're going to have the chart of accounts here. We're going to have the original trial balance. Let's call it what it is, the unadjusted trial balance. We are going to here record the adjusting journal entries. Here is your debit to wages expense. There's Riley's 400, debit wage expense, and credit wages payable, okay? Next, we're going to prepare the adjusted trial balance. The adjusted trial balance. Wow, man, it's getting big, huh? So look at what we did here. We have an incorrect or unadjusted trial balance. We have the adjusting entries, and now we're putting in the correct numbers. Look at cash and accounts receivable. You never correct cash or receivables. You don't go into the safe at the end of the month and come back to the boss. Hey, boss, I just checked in the safe. We don't have $470. We only have $300. And the boss says, okay, adjust cash. No, it doesn't get adjusted. Neither does the AR. So you have no activity. So the balance is still 470. The balance is still 3,100. What happened with supplies? It had a debit balance. Our adjusting journal entry said we used 60 with a credit. That leaves a debit balance of 20. Same thing with the prepaid insurance. Remember that one? Prepaid insurance, 700. We credited it, and now we have an asset that's now down to 630. So this column here, your adjusting trial balance is this plus or minus this, or another way to say it, this number here, debit and credit as needed. We now have wages expense recorded. The extra wages, this is the amount that Riley earned during the month. Here's what she earned the last week of the month unpaid. We accrued supplies expense, huh? Where's supplies expense? Come on, where's my supplies expense? Oh, here it is. Here, I'm sorry, I'm in the wrong column. Yeah, we debited supplies expense for 60, and we credited the supplies asset. We debited depreciation for 80, and we credited the accumulated depreciation, which went from 0 credit balance to an $80 credit balance, and we just moved the numbers over here. This is the hard part right here. Now, once this is complete, these two columns equal, these two columns equal, these two columns are the same. Now, we're ready to do our income statement and balance sheet. This is the hard part, these two columns here, doing the entries. Remember the Bob Smagula trick? Everything above delivery fees is balance sheet. Everything below is income statement. So let's see what we got here. We're going to extend the balances. This is a lot of verbiage that I think you will understand. Extend the adjusted balance to the, we're going to move the revenues, expenses to the income statement, and the assets, liabilities, and capital to the balance sheet. I bet you knew that, okay? So here we go. Here we go. Remember what I said? Everything below drawing is your income statement. Here's your income statement. There's the sales. These are your expenses. That's pretty easy, huh, Roby?
Yeah.
Okay. Everything above it is the balance sheet. So they brought the balances over. Don't make the mistake that is easy to fall into. You're saying, okay, I got to bring the balance over, and you bring these balances over. No, these balances are no good anymore. You go here, 470, 3,800. You bring over the 20 that's left, etc. Okay? But look here. The first three columns, the debits equal credits. This last column is not the case. We have a difference here. That's good in this case because the credits, sales are higher than the expenses. There is your profit right there, 4,000, was that, whatever the number is, $40,640. That's your profit. So we're going to add that to the expenses here to zero them out. And now this equals this. If we've done this correctly, we are going to have this difference here on the other side. Add them up. And we're pretty much done. Okay? The worksheet, basic worksheet. Every company uses something like this. Of course, it'll be on a screen, but this is it. And they talk about finding errors. Yeah, we already talked about that. The worksheet is a tool of organization. I don't think I could ever prepare a financial statement without using that kind of worksheet. Nobody could. So what do we have here? We have our beginning balances here. Here are the adjustments. And here is our journal entries. We debited supplies expense, debit supplies expense. We credited supplies, we credit supplies. Okay? The adjusting journal entries. I am not going to talk about the cash basis or modified cash basis. Nobody uses it. It's not GAAP. If you go on a cash accounting basis, you'll cash accounting basis your way out of business in no time. There's no reason to really teach it other than on a cash basis, the cash and the expenses occur at the same time. Anyway, here's what we're learning. Accrual basis. Revenues are recorded when earned. Same thing with expenses. And please bear with me for just a moment. Can I stop the recording for just a moment, please?
Okay with me.
Okay. Can you still hear me, Roby?
I can.
Okay, that's good. Just had an appointment with this guy. I kind of forgot about it. Hopefully he doesn't yell at me. Hi, Barrett. Hey, Bob Smagula here. Hey, I'm
I can see it too. Are you there?
Can you hear me? Yeah.
Hello?
Hold on 1 second. I'm trouble with the phone.
I can't hear you though,
I hope this guy calls me back. Okay, let me get the recording going again. All right, where were we? Okay, we're back recording. Accrual basis, everything is recorded when it happens, okay? It is the only method permissible under GAAP. No one is going to loan you money. No one will do business with you if you don't use the accrual-based method. Accrual basis of accounting. Cash basis, we're not going to really talk about. Not going to talk about it. I don't even know what modified cash is to basis, to be honest with you. We're not going to go over it. It's certainly not going to be on a test. It might be on your homework a little bit, but not on a test. I would never give that question out. Okay. Now we're getting into the appendix on depreciation methods. I don't think we want to go into this just now. I need to check with my boss, Cornelia. I just want to see something here. Okay, we'll go over straight line. There are various depreciation methods, and you'll get a lot of this in 230. You'll get tons of it in 230, okay? But we're working with straight line. Straight line is the one we're working with. We will assume that a van was purchased for $40,000 for 5 years. Notice the salvage value was 4. You do not depreciate the salvage value. So 40 minus 4 is 36,000. 36,000 divided by 5 will be our yearly depreciation. Or 36,000 divided by 60 would be 7,200 a year. Let me just back it up again. Salvage value 4,000, which we don't depreciate. Subtract it. What we do depreciate is 36,000. We depreciate 36,000. And we divide it by 5 years. We get $7,200 a year. That's going to be our debit to depreciation expense and our credit to accumulated depreciation, or $600 a month if you want to do it by months, okay? And they're just showing you it's a percentage. If it's 5 years, it's 1/5, right? If it was 3 years, it'd be 1/3. And take a look at this. Here's a depreciation schedule, huh? Depreciable cost was $3,600, right? And we figured out that 36,000 divided by 5 is $7,200. $7,200. So 36,000 minus 7,200 gives us a net book value of 32,800. Then the next year we depreciated 72, so this goes down to 25. Next year, etc. After 5 years, notice that the net book value equals the salvage value. We can never depreciate below the salvage value. Never. And give me one more second here. Okay, we're not going to go into the other methods. So I think we had a solid look at chapters 4 and 5. I will double check with Cornelia on whether we're going to go into the other depreciation methods. I don't think we do. I don't think we do. So anybody have any questions, any comments?
Sounds pretty clear.
Feel pretty good with this, Roby?
Yeah.
What do you think, Natalie?
It all seems pretty good.
Pretty good? All right, Riley, what do you want to say to me?
It's good. I think I understand it.
Yeah, it's a little tricky. You'll understand. Yeah, I think you understand it, and you'll do okay. Just remember, these adjusting journal entries are a search for unrecorded expenses at this point. So we're going to debit an expense, and we're going to credit either a liability or an asset we've used, huh? Or that contra account. So, okay, I guess I'll let us go here. And I know you don't want me to say this again, but boy, the Jets got murdered again yesterday. The New York Jets could be the worst football team in history, seriously. And a lot of nasty people like me are hoping they don't win any games this year, but we'll see. Okay, you take care, everybody.
Tampa Bay Bucks in 1997
What's that?
or whatever. Worse than the Tampa Bay Bucks in 1970 or whenever it was that they just started.
You mean the Milwaukee Bucks you're talking about?
No, the Tampa Bay.
Oh,
Tampa
yeah. That
lost.
was a, yep.
They lost,
Yeah,
I think, for 2 seasons. They didn't win a game for 2 seasons, I think.
You are correct, sir. They didn't win a game their first, 2+ years. They were terrible.
Yeah.
They still stink, but those are the old days. All right, well, take care, everybody. Bye-bye.
Bye.
Da, da, da,
Bye.
da.